Hello, this is Don Anders from Anders Retirement and Investment Advisors. A lot of you who've already seen our first two videos know that we talked about fixed and fixed indexed accounts. If you haven't seen those, my recommendation is to go back and watch them. We're also going to link it up above. In this video, we're going to talk about market-based accounts that we currently like. Okay, let me once again remind everyone, these videos are not advice, okay? So when I record these videos, I'm talking about things that look appealing right now or current market conditions. We don't know your situation. We don't know what you need, what your goals are. So please do not take this video and say, "Oh yeah, well the Don Anders on YouTube said to do this and I'm just going to allocate my portfolio that way without knowing the pros and cons or what you're getting into or specific funds or anything else, because everyone is different, right? So you need to sit down with the advisor and talk about the pros and cons of doing different investments, especially when we're talking about market-based accounts, okay? Because that involves risk, that involves needing a long-term objective for your investments because you might lose money and you really need it to be there long enough for it to work itself out. But right now, most of you know that the market has been pretty volatile, right? Ups and downs, ups and downs. Even as great, I mean, obviously 2022, the third quarter of 2023. But even if we go back, right, 2020, right, we saw 30% dips in the S&P 500 at one point. So if you're looking for a market-based account, how do you invest in stocks or bonds and have some consistency, right? And have just a little bit more, a little bit less of this and this, and a little bit more of maybe this. The way that we're seeing right now that has been pretty consistent through all of the years is dividend paying stocks. So a lot of you have probably heard of this, but dividend paying stocks and portfolios, we have a portfolio with a company called 8U Wealth Management that we use that is, it was actually up because of the dividends in 2022 when the S&P 500 was down 20%. Now, the benefit of dividend paying accounts and the reason that we like those right now, if you're going to go into the market, is if your account drops, then the dividend will get reinvested into the account if you choose it to do that, and it will buy more shares low, right? If the account goes up, great, it goes up, and then there's a dividend payout. You can also use dividends, as most of you know, as income if you decide to do that, which some people need that in retirement. I personally right now like the idea of taking income off of a fixed account because fixed accounts are going to pay right now as much as a dividend paying, and you won't have the fluctuation. But it is an option if you don't want to go with a fixed account and you just want to be fully invested in the market. So dividend paying stocks are pretty good. The other thing that we like right now are bond funds. Now, if you've watched my videos in the past, you will know that I warned about bond funds a lot when interest rates were low, because bond funds work inversely of interest rates. And what we were saying back in 2019, 2018, 2020 is if interest rates go up, bonds are going to go down. That's why a lot of your portfolios, those of you who are invested in the market, you thought you were being safe by going with the target date fund, right? Oh, well, I have a 2030 target date fund. Well, what you didn't realize was they were buying more and more bonds while interest rates were at all-time lows. And when interest rates rose, the stock market went down and your bond funds went down. So that was not a great time to be buying bonds. That's why I'm not crazy about those target date funds. They sound good in theory, but it's just an algorithm, right? So you don't have someone saying now is not a good time to buy bonds. It's just an algorithm that says we have to buy bonds based on your age. But now that interest rates are high, bonds are looking a little bit better because number one, they're paying higher dividends, right? So you're We have bond fund portfolios that are in the 5-6% range. But on top of that, if interest rates drop, the bond funds will go up in value. Now you say, okay, Don, well, what if interest rates go higher? That is a possibility. And depending on what the bond fund is, there's this thing called duration. You could lose money if the interest rates go higher. Most people think that we're pretty close to the top, but it could happen. But the benefit is if interest rates go just a little bit higher, then you still have dividends coming in to offset if it loses money. So we're really looking at that as a pretty low risk right now that interest rates are high. That being said, if you're watching this video, uh, you really need to be careful because they're not all bond funds are created equal, right? There's treasury funds, there's corporate bond funds that are good. There's what's called junk bond funds that look really good and sound really good, but the companies could go out of business. So there's still a lot of risk there if you're not careful. This is where you need to talk to a financial advisor who knows you, knows your situation, and knows the market. Okay. So it's something that I would recommend looking into. Now, investments that I personally am not crazy about right now, you really have to be careful with the really risky stuff, right? Crypto's bouncing around. Be careful with that, like always. You're also growth tech companies, those types of things. Right now, money isn't free anymore, right? So for a while, companies could go get loans at 1, 2, 3%, and invest and grow their companies. Now that money is no longer free, those tech companies are having a harder time getting funding and getting loans. So just be careful with those aggressive growth tech companies and other companies that are looking to grow, because it's, without capital, it's hard to grow. But the established accounts are paying dividends. We still like those depending on what they are. Not all dividend paying funds, but a lot. So once again, not advice. We like, when I say I like something or it looks good, I am saying very specific stocks and bonds and those types of things. And as most of you know, I'm not here to give stock advice. I never do. So it's actively managed, and I guarantee you that for my clients, they know the companies that are good now, they're probably going to have something different next month and the month after, because we actively manage those portfolios based on how times are changing. So if you want to talk about anything we talked in this video, if you want to sit down with a financial advisor, it costs nothing to do. We have all of our appointments. We do complimentary. And then from there, we can discuss options. We can discuss portfolios, plans. If you want to hire us, we can discuss what that involves as well. But you can at least talk to an advisor, bounce some ideas off of them before that. It could be me, it could be one of our other advisors. Also, if you want to talk about one of the fixed or fixed index options, you can do that as well. As always, there's a link down below. Feel free to book that appointment. We'd love to talk with you. And then we'll go from there. Also, as always, please consider subscribing. It really helps us out. It shows us to more people who are in the FRS or looking for investment help. And then also like it. And if you have anyone that needs this video or you've been talking about investments with, please consider sharing our videos. That's the biggest compliment you can give us. Thank you so much, and we will talk to you in the next video.